안녕하세요. 글로벌 시장에서 통하는 투자법을 알려드리는 뉴욕나우 한국경제신문 강영연입니다. 오늘은 저는 글로벌 X 본사 앞에 나와 있습니다. 여기에서 미셸 쿨루버 포트폴리오 전략가와의 인터뷰를 하기로 했는데요. 이 사람은 글로벌 X에서 2018년부터 일했는데 그 전에는 메릴 린치에서 ETF 모델 포트폴리오 사업을 담당했었습니다. ETF 모델 포트폴리오가 뭐냐 하면 ETF를 활용해서 여러 지역 그리고 산업에 투자를 하는 건데요. 자산 배분 전문가라고 할 수 있습니다. 요즘 변동성이 커지면서 개인들 중에서도 자산 배분에 관심을 가지시는 분들이 많은데 어떻게 하면 좋은지 그리고 왜 해야 되는지에 대해서 자세히 물어보도록 하겠습니다. 지금 바로 만나러 가겠습니다. Hello, Michelle. Nice to meet you.
안녕하세요, 영영.
Wow. Thank you for joining us today.
It's really great to be here with you. Thank you.
Okay. How do MG generation like me allocate asset? I earn a certain income monthly and I have about 20 to 30 years left until retirement and expected returns about 5 to 7% per year, and I hope there's no loss. Is it possible?
So, millennials and Gen Z are still in the contributing phase of their investment careers. And so, within this stage, a drawdown in markets isn't actually the end of the world, because this is just an opportunity for people who are still contributing to be able to buy in at lower valuations. And so, what's very important for these investors is actually stick with the game plan of making sure that you're consistent about buying in despite what markets are doing. But also when thinking about how to position as someone in the younger generation, it's also your risk tolerance is typically higher with having a longer horizon. But also when thinking about that, there are also reasons for needing liquidity. And so when positioning portfolios, it's really important to also consider short-term liquidity needs. And for example, needing to repurchase cars, houses, or even needing to study and save up for that. And so thinking of your portfolio in short-term liquidity needs and then longer-term liquidity needs, and then being able to position your longer-term liquidity needs towards areas where you believe there's longer-term growth. So for people within this age group, it's typically possible to have a diversified portfolio that's tilted towards equity, as well as having exposures that provide unique exposures that are long-term growth focused.
Could you make us some portfolio for MG generation, like equity 30% and bond 30%?
So I'd be saying typically you'd be going closer to like an aggressive portfolio, so you could even be going closer to your 75-80% equity side.
78% equity?
Like 70 to 80% equity, yeah. Because you're not currently needing to be thinking about income. You're not needing the stability. If you're not needing to be drawing on the assets for the next 30 years, you can take a drawdown as your time horizon is very long. The issue is if you have short-term liquidity needs. And so being able to make sure that you've considered your short-term liquidity needs first before positioning for long-term growth.
And how about the reason, the only 70-80% in US equity?
No, like equities generally. So I'm assuming Korean perspective, you'd have more Asian exposure relative to a US investor, but US exposure would still be high just from a global perspective.
Okay, then let's assume people older than me, the people over age of 60, who are about to retire or have retired. They probably have a lot of assets, but their monthly income will decrease. I think they need more conservative approach. What's your opinion?
Well, above 60 is a very wide age group, so it fully depends on their age as well as the amount of assets that they currently have saved up. But yes, I would agree it should probably be in the range of a balanced towards a conservative. And so someone at the beginning of this stage, when they're still thinking about retirement but haven't yet got to that stage, they're likely to have a higher level of equities into their portfolio. Within a balanced portfolio, we typically have close to 60% equities, but as you're approaching retirement, this is typically brought lower just to be able to prepare yourself for retirement. Because when you're approaching retirement, your investment horizon starts reducing. And so you're getting ready to be moving on to withdrawing income off your portfolio rather than being in the contributing phase of your portfolio. And so this is really important of shifting down on your asset allocation, increasing your fixed income and becoming more conservative in your positioning. When we're looking from the more balanced, moderate type of the portfolio all the way down to the conservative, within our conservative portfolios, we'd be having around 10% cash exposure. This is a large amount of cash focused on capital preservation. And then in addition to that, we have around 70% on fixed income. And that's focusing on providing stability. And so combining cash and fixed income, you've got majority of your portfolio in positions that have very low volatility and aren't likely to have major drawdowns, as this is what's very important for somebody who's in the capital preservation portion of their lives. But at the same time, for someone who is retired, there's also the importance of longevity risk. And so there's this huge balance between capital preservation, income needs, and the need for growth. And so for investors who are in this environment, they're having to augment their income-focused strategy with areas that can actually have some growth as well as provide a good yield. Equity income solutions are an area that can actually provide some solutions that can help in a small amount within this type of environment. But they also do react differently to different market environments. We have an equity income portfolio at Global X. And within our strategy of how we manage this portfolio, key importance areas is diversification of exposures as well as diversifying the sources of yield.
And same question, could you recommend some percent portfolio?
Sure. So we actually have an equity income portfolio that we manage at Global X. We have around 30 to 40% in the core exposure, which is, we call it core dividend. So it's your good dividend. It's also your slightly higher quality exposure. It's value focused, but it's not deep value. It's also large cap focused. Then we have just under 10% in your high dividend segments. And these are the segments that when everything's going well and there's a high demand for dividend paying stocks and corporate earnings are good, those do well. But it's also an area where it's more sensitive to the market environment. And so we're very cognizant of positioning in that segment during periods that are more challenging. And then it's also complementing that exposure with areas that do better in a more range-bound market. For example, covered calls. We typically have around 20% exposure within that segment, with about 10% in the preferred side. And then in addition to that, diversity of exposure is really important when thinking about equity income, because one of the main challenges for an equity income portfolio is actually concentration risk. Is a lot of the yielding products fall into a few specific sectors, and those typically are very value focused and provide a good yield, but they won't perform well across all market conditions. And so the way that we actually manage is we also include in a few sectors that are specifically targeted at areas that are missing from the portfolio. And so that rounds out the portfolio and makes it more balanced through market cycles.
How much recurring they have to contain their portfolio, older people?
So that's more going on to the capital preservation side. It fully depends on the level of assets that somebody has. And so I've seen portfolios ranging from the 10 to the 30% when you're focusing on capital preservation, because you're trying to aim for very low volatility because you can't take any drawdowns. That's a more challenging space to be in, especially in a high inflation rate environment, because you need to have some growth in order to offset what's happening with inflation.
Many investors make an all-in invest in one area, such as tech stock or sometimes crypto, and they believe that's the only way to make money. I don't think you agree with that, but so why we should allocate us that?
Well, asset allocation is essential. It sets the foundation to your portfolio. The first point to this is thinking about what is the objective of the investor, risk tolerances, time horizon. And this creates the foundation in order to navigate your markets safely. When thinking about asset allocation, it's essential for risk management. A concentrated position, similar to what you were mentioning earlier, can provide excellent returns for a period of time. But the top performing asset classes change quickly. And being in a concentrated position means that you need to be thinking quickly about what positioning you want, as well as getting your timing right. These are more challenging things to always get correct from an investment perspective. And so also when thinking about asset allocation and diversification, these are essential both within asset classes as well as across asset classes. So from a portfolio management perspective, when we're talking about diversification, we're trying to look at including assets that have a low correlation with each other. And so they respond differently, and thus when we go into different environments, it actually helps smooth out your returns over time.
Then some point out that the return from asset allocation is too low, and on the other hand, when there's a lot of volatility, we lose the money even if we allocate the asset. And then, why should we do it?
Well, asset allocation creates your foundation and your framework. It creates a safe space in order to navigate the market. Yes, it is true that even with a diversified portfolio, when markets go into a panic situation, you can still lose money when you're diversified. But it's within those environments that the diversification actually shows its real benefits of diversifying to prevent larger losses. And so even within a current environment, like year to date, we have seen the correlation between assets increase, but there's still diversification benefits of having multiple assets within a portfolio. Especially within the current environment, we've definitely seen that with having more cash as well as commodity exposures currently. But over time, even the correlation between equity and fixed income is typically low, even if it hasn't been year to date.
Then individual investors think that asset allocation is difficult. So is it possible for an individual investor to allocate asset without the help of expert? Even if then, what's the way to do it?
Yes, but it takes time and commitment. ETF products are a great way to provide diversified core exposure. But then in addition to that, you can also use these products to create key areas that you have interest in and set aside risk buckets for example, areas that you might have an interest in. For example, robotics, clean energy, or maybe even cybersecurity. And so those risk buckets can be used with ETF products or other products as well. And it'll depend on the risk tolerance of an investor, the level of those risk buckets that they could set aside.
If I use the ETFs to allot asset, how many ETFs should I use to allocate asset?
That completely depends on what you're trying to achieve with your portfolio. So if you're looking at a portfolio from the simplisticest level, you could potentially just use 3 ETFs to represent a multi-asset portfolio with equity, fixed income, and cash. But at the same time, a single ETF that just provides global equity exposure doesn't have the nuance of being able to tilt between regions that you believe are likely to do well. And even looking within the international side, it's extremely useful to be able to tilt between developed markets and emerging markets. And then looking into US, being able to express sector views or potentially size and style views. These are all things that ETF products are exceptionally good at being able to do. And then in addition to that, you can also express areas of interest, such as more on the thematic side, or if your portfolio needs to tilt towards income. And then going towards the fixed income, there's also nuances that could take it away from just the broad aggregate products. For example, focusing on duration views or credit. And so it really comes down to what you are intending to do with the portfolio and if the investor has strong views on the market. Because certainly for someone who just wants to broadly track the market, 3 ETFs is great. But if they have views, they're going to need to be able to express it more.
Now, what do you care most about when you allocate asset? For example, oil prices or GDP growth rate or geopolitical issue? And on the other hand, what factor do you not care about when you allocate asset?
So those are all really important factors to consider, but the factors to consider change constantly over time depending on the market environment and what's important currently. So looking at the environment currently, GDP growth and inflation are the most important. And those all feed into what is the Fed likely to do and central banks globally. So within a current environment, those are the factors that we're looking at the most closely. And then in terms of what you're asking about, what do we not look at much? Our portfolios are more US-centric as well as developed market and key emerging. So there are certain regions globally where we're not looking at every data point unless there are key geopolitical issues that could make that region important from a global growth perspective.
How about the Ukraine or?
Exactly, that's a key example, yes.
I think rebalancing is one of the difficult parts because when and how often do I have to rebalance? For when various issues arise, is it right to rebalance each time, or is it better to set a time point and do it mechanically?
So the frequency of rebalancing completely depends on how tactically you want the portfolio related to the macro environment, as well as the taxes on capital gains that are relevant to that investor or your portfolios in general. And so at Global X, we typically rebalance around quarterly, but we do also have 2 portfolios that rebalance on a monthly basis. The 2 portfolios that rebalance monthly include a momentum factor, and that's why they need to rebalance on a monthly basis. And they're completely model driven. And due to that, they can be rebalanced in a very mechanical way at a set point each month. But then looking at our asset allocation portfolios, these typically rebalance on a quarterly basis, but it can be more or less frequently depending on market conditions. When we're thinking about rebalancing, we're trying to express our views on expectations for the market. And so it's not necessarily related to what the market has done or reacting to what's happening to the market right now. It's reacting to what we believe is going to be going on. And so it's making sure that we have a strong view and conviction on why we're doing something.
Okay, thank you, Michelle. Thank you for joining us and sharing your insight. Thank you.
Thank you very much.